Hi, I'm Karly Iacono, and welcome to Commercial Real Estate Now. Today marks a significant shift in monetary policy. The Federal Reserve has just cut interest rates again, halted its balance sheet runoff, and admitted that the government shutdown has left it partially data blind. For commercial real estate investors, this is the new operating environment for how we structure debt, assess risk, and time capital moves. Let's break down exactly what the Fed said, where the economy stands, and how to translate that into 5 actionable investor strategies today. Let's start with the facts from today's meeting. The Fed cut the federal funds target range by 25 basis points to 3.75 to 4%. It ended quantitative tightening effective December 1st and will start reinvesting Treasury runoff instead of shrinking its balance sheet. Chair Powell made it clear that another rate cut in December is not a foregone conclusion. The Fed described the economy as expanding moderately. Job growth has cooled, job gains have slowed, unemployment has edged up, but it remains low, and inflation is still somewhat elevated. Because of the government shutdown, official data feeds are delayed, so the Fed is relying more on private sector indicators. In short, the Fed has shifted from tightening to neutrality, easing slightly but with caution. Growth is modest, inflation sticky, and clarity is still limited. With that as the backdrop, let's move into 5 investor actions that matter right now. Number 1, re-engineer your financing before the market does it for you. Rates have ticked down, but Powell's message is clear. This isn't a rate cut cycle you can bank on. That means now is the time to re-engineer your capital stack, not chase short-term relief. Lock in certainty, not just savings. If you can refinance into fixed debt below 5%, do it, even if spreads aren't perfect. Stability beats speculation. Negotiate built-in flexibility. For floating rate and bridge loans, add extension options or refi windows at modest prepaid costs. Treat flexibility as a hedge against a stalled December option. Model dual paths, a base case where rates are steady and another with an upside of 25 basis points on an additional cut. Test your DSCR and yield under both. Number 2, evaluate tenant margin shock risk. Powell flagged continued inflation pressure from tariffs and good costs. That hits tenant margins before it hits your rent roll. Retail and restaurant tenants will see higher input costs, so watch for early lease renewal hesitations or concession requests. Action? Segment your rent roll by sensitivity to goods inflation and labor cost. Rescore tenant risk by EBITDA coverage, not just credit rating. Number 3, build a liquidity cushion while everyone else relaxes. Ending balance sheet runoff will ease systemic liquidity, but it's not going to flow evenly. The Fed admitted money market stress led to this change, a sign that reserves are still tight. Action, hold 6 to 9 months of debt service and CapEx liquidity per asset if you can. If volatility returns in December, you'll be a buyer, not a forced seller. Number 4, reprice equity and partnerships now. When monetary policy pivots, private capital is always the one to lag. You'll have about a 60-day window before valuations catch up to cheaper debt. Your action item, re-underwrite JV terms or promote waterfalls with today's assumption. Lock new equity capital commitments while spreads are still wide. Institutional partners will tighten thresholds once pricing stabilizes. And number 5, anticipate behavioral slowdown, not market collapse. Despite headlines, Powell described the economy as expanding at a moderate pace. That means we're entering a slow growth, high awareness phase, not a crisis. Tenants and lenders alike will move more slowly. So focus on tenant retention. Renew early, maybe even modestly below market. In a wait-and-see economy, velocity is going to win over pricing perfection. To wrap up, the Fed's October pivot brings cautious optimism, but no guarantees. We're in a window where smart capital acts before the consensus forms. Lock certainty into your financing, evaluate tenant exposure, preserve liquidity, and reset partnership terms while the spreads still favor you. I'm Karly Iacono. Thanks for joining me on Commercial Real Estate Now. Follow me on LinkedIn and YouTube for data-driven insights on CRE investing in this evolving macro landscape.